The ins and outs of investing can leave just about anyone scratching their head. Symbols and numbers scrolling across the ticker can look like hieroglyphics to the average Joe. And these are just the basics of Wall Street. So when it comes to more complex subjects like hedge funds, even the experienced investor may not have total understanding of what exactly a hedge fund is.
A hedge fund is a collective investment vehicle which seeks to make returns from markets, but can make returns independent of whether the markets go up or down. It's a very broad church of investment strategies, but generally it's ones that can use leverage, they often use derivatives, and they seek to make a return independent of market movements. There are many myths about hedge funds. The first one is that they're all risky, they should only be used by very rich people, etc. The reality is there are a broad range of strategies. Some of them are very risky, some of them are very low risk, and in fact what's interesting about them is they often have low correlation to normal stock market type returns and also to bond investing, and therefore they can, in the hands of a sophisticated investor, be combined with traditional investments and produce a portfolio that's able to weather poor market conditions better.
When investing in hedge funds, there are many schools of thought among money managers as to what the best plan of attack may be. One unique idea gaining traction: trend following, an investment methodology with very different characteristics to traditional investing. Over time, trend following has proven to offer strong, non-correlated investment returns along with meaningful portfolio construction benefits.
Basically, what trend following is following the money in a risk-controlled manner. And that's the important thing, risk control. It really doesn't matter to us if the price is going up or down. What matters is that we can follow that trend in a risk-controlled manner. Because basically, it's a positive mean gain.
The main characteristic of trend following is the ability to invest in the direction of markets without any preconceived notion of value. There are 5 main principles of trend following. Trade lots of markets, risk small amounts per trade, always know your maximum risk, cut your losses, and let your profits run. As a result of these principles, trend following is a strategy which typically loses on more than 50% of the trades. However, net it's a profitable opportunity because the losers are small and the winners are large.
In 2008, Stanley Fink formed ISAM. One of ISAM's key strategies is ISAM Systematic, a world-leading futures-based strategy specializing in systematic trading through the use of advanced statistical methods.
The ISAM Systematic strategy trades around 80 global futures markets, and we don't trade with our own discretion. We trade 100% systematically. So we create computer programs which monitor markets right around the clock, and it identifies when a trend is occurring in a market, and it will trade in the direction of that trend. Our approach is pure trend following, and that means we'll never add to a losing position. So we cut all of our losses short and we let our winners run.
We follow those trends in a very carefully risk-adjusted way and very diversified, from markets such as agricultural commodities through to financial markets. The methodology is when a trend changes, we cut the position, so there's rigid risk management built into the system. It tends to give you a low or indeed negative correlation to other hedge fund styles and conventional markets.
We use a wide range of statistical methods to identify when a market is trending, and each of those methods will look at a wide range of timescales, from a couple of weeks to many, many months. And the final position we take is an average over all of those systems and timescales. But ultimately, an investor should never be surprised by the position that a trend follower has. It will always be, ultimately, in the same direction as the trend.
We now live in a world that has experienced a major financial crisis, where investors are constantly looking to protect their investments from a global meltdown. Identifying and measuring an investment strategy's ability to thrive in that sort of challenging environment has become increasingly important. As a whole, trend following benefits from the markets moving significantly regardless of direction, and therefore can be a strong source of returns during these periods.
One of the main benefits of trend following is the lack of emotional attachment and the ability to adjust positions to the prevailing market direction. 2008, in the fourth quarter, had a general market downturn. Trend following adapted to that by being short equity markets. In analyzing several centuries of data, these kind of opportunities, whether it's 1974, the Great Depression, or bear markets through the 16, 17, 1800s, typically create the most fruitful opportunities for trend following systems.
I think we're having more and more things to trade. Strangely enough, that makes it safer for people like us, because we get to diversify our bets over time, geography, and diversify our risks. And that's very important. The biggest fundamental in markets, people. And I don't think people have changed in thousands of years. The emotions of people are the same. So people will run when prices go against them, long or short, and be happy when they go in their direction. So the same emotions play.
A systematic approach to investing is very important because most investors tend to be emotional, and if they really believe in a position, they'll continue to hold it even when the market moves against them. That can result sometimes in very large losses. With a systematic approach, particularly like ours, we tend to cut losing trades very quickly, and that gives you a very predictable set of return streams with a low correlation to that which traditional investment classes give, and indeed sometimes in times of market stress, a negative correlation that can protect somebody's overall portfolio.
Hedge funds may well be the most misunderstood sector in the world of finance, but aligning ourselves with investment professionals who take a systematic, proven approach may help us uncover suitable and attractive opportunities for our portfolios. For more information, go to isam.com or call 212-561-1227.